So this is a year-over-year decline, the first since 2020 that we've seen from Tesla.
Is Tesla really as invincible as its fanboys claim? Can Elon Musk's tweets continue to prop up the stock price, or are we about to witness the ultimate Twitter meltdown? Well, grab your popcorn and hold on to your seats, because today we are diving headfirst into the thrilling world of fears of a Tesla stock crash. How low can Tesla's stock price go? Tesla's stock price has taken quite a hammering lately, leaving investors wondering just how far it could potentially fall. Is there a bottom in sight, or are further declines ahead? In a captivating discussion, market analyst Brian and stock expert Curious Peggy dive deep into the factors that could influence Tesla's share price trajectory over the short and long term. Buckle up as we explore the depths of this roller coaster ride. To set the stage, Peggy provides insights into the recent performance of Tesla's stock. This whole year, it's been down about 20 to 25%, she notes, attributing the decline primarily to negative market sentiment surrounding Elon Musk's perceived lack of focus on Tesla. However, Peggy is quick to dismiss such concerns as absolutely ridiculous, arguing that the real drivers are Wall Street analysts and institutional investors with a shorter-term investment horizon. But why do these influential players hold so much sway? They want to make money in the next 6 to 12 months, so they're not going to wait 5 years like us retail investors, Peggy explains. These powerful market participants are fixated on Tesla's declining margins and lack of clear guidance for 2024, factors that contributed to the stock's 10% plunge following the Q1 earnings call. Despite the sell-off, both Brian and Peggy see the current share price as a bargain, with Peggy stating, "The stock below 200. What a bargain." They argue that the market fails to appreciate Tesla's growth potential and its expansion into new industries, instead myopically focused on near-term vehicle profitability. But is this short-sighted view justified, or are investors overlooking the bigger picture? One area of growth for Tesla is its stationary storage and megapack business. Peggy estimates that the market has realized only 10 to 20% of the potential in this segment, as revenue growth has been stagnant but profitability has improved. She acknowledges that it's a lumpy business, meaning revenue can fluctuate significantly from quarter to quarter, which confounds Wall Street's desire for consistent growth. But is this lumpy nature a cause for concern, or simply a reflection of the industry's inherent volatility? Peggy seems to lean towards the latter, suggesting that the market's impatience may be masking a longer-term opportunity. The thing with megapacks is it's ramping, but the revenues have been pretty much stagnant, she notes. But since every single quarter of 2023, the profits have been increasing. Another significant upside for Tesla lies in its pursuit of full self-driving, or FSD, capabilities and autonomy. Peggy believes some investors have priced in the potential of FSD, but she cautions that it's challenging to quantify the financial impact accurately. If you look at when Tesla does solve the FSD and they do deploy it throughout all the Teslas all around the world, then in that argument you can say it's not priced in at all, because it's obviously ridiculous what the jump is going to be, what the valuation is going to be. However, Peggy acknowledges that a delay in FSD could create short-term downside risk for the stock, as some investors may have bought in anticipating a more imminent resolution. But is this risk overstated, or does the potential payoff justify the wait? After all, Tesla's track record suggests that delivering on ambitious goals is a matter of when, not if. Tesla's ambitions extend beyond vehicles and energy storage, with the company exploring opportunities in robotaxis and general-purpose robots, the bot. Peggy sees the robotaxi as having significant upside potential, but notes that it's difficult to quantify at this stage. How do you price such a thing in? What format do you go like? For me, in my evaluation, I don't even price it. I'm like, how do you do it? She ponders. The challenge of valuing paradigm-shifting innovations is a familiar one, and history has shown that those who succeed in quantifying the unquantifiable can reap immense rewards. But it's a high-risk, high-reward proposition, one that requires a keen eye for identifying game-changing technologies before the rest of the market catches on. As for the bot, Peggy believes it's not priced into the stock at all currently, and she's unsure how one would even begin to value such a revolutionary product. Is it each bot is going to be costing $10,000, $20,000, or is it going to be based on wages because it's going to be leased out? But by what rate? By how much? She asks rhetorically. The bot represents a new frontier, one where traditional valuation methods may not apply. It's a bold bet on the future, a wager that Tesla can once again upend an entire industry, or perhaps create an entirely new one. But in a world where the unimaginable is rapidly becoming reality, is it wise to dismiss such ambitions as mere fantasy? While the upside potential of the bot is immense, Peggy acknowledges the possibility of downside risk if the program encounters significant delays or regulatory hurdles. However, she doesn't anticipate a major stock impact even if Tesla were to pull the plug on bot today. This begs the question, how much faith do investors truly have in Tesla's ability to deliver on its boldest promises? According to Peggy, the most significant short-term downside risk for Tesla's stock is the trajectory of interest rates. If rates don't decrease in the second half of 2024 as she expects, it could weigh heavily on the stock's valuation. Tesla is sensitive to interest rates, so a lot of investors are pricing in that. Oh, interest rates are going to go down. We are going to see some bounce action for Tesla's valuation after we get the first wave or the first cut from interest rates, she explains. But what if her prediction is wrong? What if rates remain stubbornly high or even continue to rise? In a high interest rate environment, growth stocks like Tesla could face significant headwinds as investors gravitate towards safer, more defensive plays. Additionally, further price cuts by Tesla, while beneficial for increasing sales and lowering costs, have historically triggered sell-offs as bearish investors interpret them as a sign of weak demand. As soon as a price cut happens, everyone goes crazy. All the bears come out and say, "Oh, see, nobody wants an EV. It's ridiculous." Peggy laments. It's a catch-22 for Tesla. Price cuts can boost sales and improve margins, but they also risk spooking skittish investors. Can the company strike the right balance, or will it be forced to choose between short-term optics and long-term profitability? Peggy also cites Elon Musk's tweets and unexpected events as potential catalysts for short-term downside. Musk's controversial social media presence has, at times, sparked sell-offs, and unforeseen black swan events could temporarily depress the stock, even if the company's fundamentals remain strong. But is this risk unique to Tesla, or does it apply to any high-profile company with an outspoken leader? And in an age of constant disruption, are black swan events truly unpredictable? Or are there signals that savvy investors can learn to recognize? Despite these potential pitfalls, Peggy remains optimistic about Tesla's long-term prospects, stating, "Based on the analysis that I've done, it looks like this year is going to be a recovery year for Tesla in terms of earnings and margins." How low can Tesla's stock go? Despite acknowledging the potential for short-term volatility and downside risks, both Brian and Peggy see a relatively firm floor for Tesla's stock price. Peggy suggests a range of $150 to $160 as the lowest point she envisions over the next 3 to 6 months, though she cautions that the market can stay irrational longer than you can stay solvent, leaving open the possibility of an unexpected event pushing the stock even lower, potentially as low as $100 per share. But is this floor truly unbreakable, or are there scenarios where Tesla's stock could dip even further? What would it take for such a dramatic decline to occur, and how likely are those conditions to manifest? Ultimately, Peggy's analysis suggests that at current levels, Tesla's stock represents a compelling opportunity for long-term investors willing to weather short-term fluctuations. The company's potential in emerging industries, coupled with its anticipated earnings and margin recovery in 2024, paint a bullish picture for those with the patience and conviction to hold for the long haul. Yet, investing is never a sure thing, and even the most well-reasoned analysis can be upended by unforeseen events. As Peggy notes, the stocks market can stay irrational longer than you can stay solvent. It's a sobering reminder that, in the world of investing, humility and prudence are as essential as boldness and vision. For Tesla and its investors, the road ahead is paved with both immense opportunity and formidable challenges. On one hand, the company's innovative spirit, technological prowess, and unwavering ambition position it at the vanguard of multiple disruptive industries. From electric vehicles and energy storage to robotics and artificial intelligence, Tesla is poised to redefine the boundaries of what's possible. On the other hand, the very scale of Tesla's ambitions invites skepticism and scrutiny. And that wraps up our electrifying journey through the tumultuous world of Tesla stock speculation. If you enjoyed riding the Tesla coaster with us, don't forget to hit that subscribe button and ring the notification bell. And remember, share this video with your fellow investors and Tesla enthusiasts to keep the conversation buzzing. Until next time, happy trading!